It's premature to be panicking. What we've seen is obviously a roller coaster in oil prices, big spikes on shortages, particularly in March and April, but then prices really came down in June in the wake of this ceasefire. And actually, the market started to expect that we could even see an oversupply if the Strait of Hormuz opened up very rapidly. Now, that's obviously all changed over the course of the last few days. In the wake of the Iranian daily attacks now on cargo ships, the new embargo being reimposed by the Trump administration, the volume of oil through the Strait, which last week had recovered to about a third of pre-war levels, is now back below 10% of pre-war levels. So it's more than halved. And that's now going to put more pressure on global oil and fuel and gas markets, which we're starting to see prices already jump about 15% since last Friday. But it's worth bearing in mind that the market still sees that both the US and Iran are trying to contain this escalation. We have not yet seen significant targeting of oil infrastructure in the region, for example. And so the market is not pricing in a crisis yet. But if we see this escalate out of control, if we see oil infrastructure start to be directly targeted, then oil prices could head over $100 a barrel over the course of the next month. And then we are back in crisis territory like we saw in March earlier this year.
And then, so what are the impacts of what the IMF is saying? They're saying that the original disruption when it happened earlier this year in the Middle East, the effective closure of the Strait of Hormuz, did not lead to a full-blown price shock because reserves absorbed what the market could not. Has that buffer now gone, in your opinion?
Yes, it has. So we've lost over 1 billion barrels in global stocks, including from the strategic petroleum reserves around the world, namely in the US and Japan in particular. And so throughout this war since March, we've been living on the oil market credit card where we've been relying on our strategic stocks to get through the disruption. And the difference as the conflict starts to take off again now is because we have 1 billion barrels lower stocks than we began with, and in fact, we're at almost record low stocks of fuel, particularly some products around the world. The buffer's not there anymore. And if the current status quo is maintained or even gets worse, then I think we're facing risks of renewed or enlarged shortages by the end of August. Australia's fared relatively well till now, but already our neighbours have faced shortages over the last few months, and that could hit us again the longer this goes on.
OK, so the credit card's maxed out. We're more vulnerable than what we were at the beginning of this conflict. You mentioned that we could have supply issues starting at around August. What do you see as the impact on petrol prices at the Bowser as well as supply when you look at how much the government has guaranteed?
So the good news is the government's done a relatively good job over the course of the last few months in maintaining fuel coming to Australia. We've obviously had to pay a lot more for it, but at least it's been arriving. We have stock levels which are actually still better than prior to it the war began, although still very inadequate and very low by global standards. And what this means for Australia is if the government is successful in continuing both its diplomatic efforts and its financial package efforts to keep the fuel coming to Australia, we should be able to at least withstand shortages, but we cannot be immune from at least higher prices. And if we do end up in this scenario where oil goes back above $100 a barrel, keeping in mind it's in the 80s at the moment, that implies fuel prices at the pump could rise 20+% over the course of the next several weeks, which no one wants to hear. But at this point, there's at least not an imminent risk of actual shortages in Australia. We are paying more, and unfortunately for some of our neighbours, they're the ones who are going without so that we can continue to use the fuel that we do here.
Finally, Saul, we know that the conflict in the Middle East leads to these energy price spikes, and that then has flow-on effects for the global supply chain. What is your observation of how that might be impacted? What products might we not be seeing coming to our shores as readily as we once have?
So the Strait of Hormuz accounts for around 20% of the world's oil and fuel, 20% of the world's liquefied natural gas, and close to a third of the world's seaborne fertilizer. Now, We've spoken about what this means for oil. On the gas side, as a major exporter of gas, Australia actually, from an economic perspective, actually benefits a little bit from the high global gas prices. But one of the most acute risks here is going to be around fertiliser. Thankfully, quite a lot of the fertiliser that was trapped in the Strait got out in the last month, which has allowed it to be, get in time into South Asia in particular for their planting and then harvest season later in the year. But the longer this goes on, the more all those supply chains are going to crack, and it flows through to every part of our economy, in your grocery basket, in your ability to get construction materials, logistics materials delivered into Australia as it is around the world. And this is coming on top of already we have inflationary pressures in our economy. So it's never good for economies when you see a disruption to just one major commodity. And now we're seeing it to three major commodities at a scale that's unprecedented since many of these commodity markets began. And so again, hopefully we see some kind of pathway which eases this pressure. But at the moment, we're on an escalatory pathway regarding the conflict, and that is a harbinger of more challenges to come across the economy.